Okay. Last time we have started talking about the exchange rates, right? We talk about the direct indirect quotation. We talk about the long run dynamics of the exchange rates, long run factors affects exchange rates movement, right? Now we start to talk about the short run dynamics. Uh, you know that exchange rates might move several percentage from day to day. Usually in these days, the exchange rates all around the world moving few percents, right? Uh, we have to understand the short run dynamics. The key understanding of the short run dynamics is uh, to understand that exchange rate is the price of domestic assets in terms of foreign assets, right? Once again, the exchange rate is the price of domestic assets in terms of foreign assets. We can say that exchange rate is the price of one asset in terms of another, right? In the past, export and imports, the trade had a very important role for determining the exchange rates, but now stock of assets rather than flow of export and imports are more important for exchange rate determination, right? But we know that the stock, the value of the all assets are more bigger than flow, right? What are those? Basically, stocks, bonds, right? These are the stocks, all assets. Uh, Farah, well, all you did, I mean, most of you did the question three. Uh, so I will not explain anything. I'm continue to exchange rate. We don't have much time. You know, we have only few lessons left. I have to finish few chapters as well. So I'm not explaining this one. But if you want, you can call me so we can arrange it. I can explain individually. Uh, right, let's move on. Right. So in your book, in this book, do you know that it's the American book, U.S. Book. So we will use dollar as a home country, United States as a home country, right? All the domestic assets are denominated in US dollar, okay? And I will use euro as a foreign country and foreign currency, right? Uh, so the quantity of dollar assets supplied primarily in the quantity of bank deposits, bonds, and equities in the United States, right? So the assets, this all of US is basically bonds, stocks, equities, I mean, and the bank deposits, right? So if you drive the, if you, let me write, talk about the supply of, let me draw it, I'm sorry. If we talk about the supply curve looks like this. I will show you. This is our supply curve. Why we have a vertical line? Because in the short run, the amount of bonds, equities, and the bank deposits is not changing, right? So that's why we have a vertical line. So this is our supply curve for determining the exchange rates. Supply curve, right? Okay. So this amount is fixed in the short run. Any question? That's good. Let's move on. Okay, here is the cartoon. Money is losing value. I should develop a tourism industry, which all of the countries try to do it, including Azerbaijan and Turkey. More people are traveling here, buying more goods and services. Demand of currency is increasing, right? So if you want to appreciate your currency, you need to create a demand for your currency, just like this cartoons. Right. Let's move on. Let's see the demand curve, right? So the demand curve, or the demand for US dollar in the foreign exchange markets, derives from the euro demand for US goods and services and US denominated financial assets, right? You know that US is the home country, euro is the, Europe is the foreign country, and the euro is the foreign currency, right? The American prices are set in US dollar, of course. So for the Europeans to buy an American goods, first they must exchange their euros for US dollars, right? So they will demand US dollars. If you want to buy an American goods, let's say the American car or American equity, anything, right? They have to put their currency to the US dollar. So this higher euro price normally reduce the euro demand for US dollar goods and services and assets, right? Let me draw and let me explain in the graph. Okay, so let me show you. Right, you see I have 4 red dots, right? In the equilibrium, assume that 1 US dollar is equal to 1 euro, right? So this vertical line is the exchange rates. So euro divided by dollar means that I'm showing the value of $1 each time, right? So this horizontal line is the quantity of dollar assets. Okay. So I have 4 dots here. The first one is in the bottom part. $1 is equal to 0.95 euro. In the upper part is $1 is equal to 1.05 euro, right? In which cases, in which one of those, choose one of those, which cases European demands more US goods. In that bottom part, I will choose one of those dots. Let me write upper part, A, B, C, D, right? So in the bottom parts, the name of the dots is A and B, the upper part C and D. So which part? I mean, choose A, B, or C, D, D, right? So we are talking about if, let me show you, we are talking about right, if 0.95, $1 is equal to 0.95 euro, what happened to the demand for American goods? Is it increased or decreased? Increase, drops, decreased. So in the initial case, assume that they would like to buy a calculator, right? So this calculator. So this calculator assume that $10 is equal to 10 euro, right? So this the initial case. $10 is equal to 10 euro for calculator. If the exchange rates drop down to $1 is equal to $1 is equal to 0.95 euro in the bottom part, right? So $1 is equal to 0.95 euro. Then this calculator became $10 in US and 9.5 euro for the because of the exchange rate, isn't it? So if it is not 10 but 9.5 euro, so what happened to the demand for US assets? Is it increase or decrease? Increase, decrease, increase. Wait. What does wait mean, Ramiz? Means nothing. They don't. So decrease. Okay. So let's see the graph once again, right? So this graph shows this is our exchange rates, and the initial case is $1 is equal to 1 euro, right here. Then what happened to the question is, what happened to the demand for American goods if the interest rate is $1 is equal to 0.95 euro? Is it increase or decrease? Well, basically, it should increase because you see, because of this calculator example, now it's cheaper for the Europeans, right? It's still $10 in US, but because of the exchange rates, now it's 9.5 euro for the European consumer. So demand for the calculator, the American calculator, of course, increased accordingly. So they demand more. They would like to buy more US assets because they pay less. Is it clear? So that's why point B will be our point. They are not paying more, vice versa. $1 is equal to 9.5. $1 is equal to 0.95 euro Farah. It's not one anymore. So for $10, they are paying 9.5 euro. From their perspective, for Europeans, for the same product, they are paying less. So that's why demand for US goods increased, isn't it? Means that demand for the dollar is increased as well. Is it clear, guys? Yes, good. So the vice versa is true as well. So the other point, if the interest rate, exchange rate increased to 1.5, I mean $1 is equal to 1.5 euro, right? That this yellow one, the point D, will be our point, right? Because now it's, if the exchange rate moved to 1.05, then this calculator becomes 10.5 euro, which is expensive for them. For the demand for this product, I mean the demand for currency, demand for US goods decreases. So what's the differences between D and C? D and C, let's see the name of the graph, I mean the horizontal axis, quantity of dollar assets, right? The quantity of dollar assets. So the quantity of dollar assets increased or decreased if the exchange rate goes up. I mean, $1 is equal to 1.05 euro. Okay. So that's why we have a downward sloping demand curve. You see? If exchange rates moves up to, let me write here, right? The in the bottom, the green one, right? If the exchange rate increased to 10 point, $1 is equal to 105, or $10 is equal to 10.5 euro, the demand for US goods decreased, right? For C, right, demand for dollar increased or decreased. For C, let me draw it. I'll show you. For the point C, yes, you see they are demanding more quantity of dollar assets. So here is the zero, of course. The initial point is the zero, right? So they are demanding more for the point C. Yes. Günel, okay. So that's why, yes, that's why if they pay more, they will demand less, right? So that's why we have a downward sloping curve, demand curve. Günel. Clear? I mean, we have to choose. Do they pay more or less? I mean, if they pay more, do they buy more or less? If they pay more, of course they buy less. Is it all clear or still you have questions? In D and C, yes, they are paying more. Exactly. If they pay more, do they demand more or less? Less, right? So that's why this point is the critical point. So that's why this D is our one of my points. If they pay less, they demand more, right? Then the other point is the B, right? So that's why we have a downward sloping curve, right? This one is the logical one. Okay, good. So here is our graph, the proper one. I mean, better than mine. But mine is more colorful than this one. Anyway, right? Uh, yes, the first. I mean, if the exchange rate dropped down to $1 is equal to 0.95 euro, right? Then the European consumer demands more. Okay, the first question. So mine is B here, not C. But anyway, in this graph, it's written as C, right? So this point. If the exchange rates goes up to which is $1 is equal to 1.05 euro, the European consumer demand less, right? So that's why we downward sloping demand curve. And of course, B is the equilibrium level, right? Because both supply and demand intersect in this point B. Okay. Any questions up to now? Okay, good. Thank you. Let's move on. Right. To understand how the exchange rates shifts or change in time, we need to understand the factors that shift the rates. I mean, this graph, this curve, right? Right. Okay, let me go to the next slide. Okay. Okay, let's start with the interest rates, right? Assume that uh, the interest rates, the domestic interest rates paid by the US, which is the home country, increased. So let's assume, let's exaggerate, US now paying you, let's say, 10% for your deposits, time deposits in a bank, or a bond pays you 10% interest for 1 year, right? And let's assume that euro, the foreign country, has 5%, right? So what happened in this case? What happened to demand for US dollar? Is it increased or decreased? US pays you 10% as an interest rate, 1 year interest rates, and euro pays you 5%. Right? The European, I mean, everything keep constant, everything other than interest rates, right? We have changed the interest rates only. So when you change the interest rates only, the European investors wants to invest in US dollar because they pays you more, right? But the US assets, we have the fixed, in the short run, we have the fixed US assets, the vertical curve, supply curve, right? Because of the high demand in that currency, the demand curve shift to the right, to the red one, right? Just Pervin says it's increased, right? So the currency, US dollar, appreciates. Is it clear, guys? Any question? Uh, okay, of course. Ulvi, think about it. US dollars pays you 10% in 1 year, right? And euro pays you 5% in 1 year. From the European investor's perspective, now it's more profitable because it pays more to invest in US dollar, right? Think about it. The exchange rate is 1 euro is equal to $1, right? 1 year later, instead of having, let's say, 105 euro, you may have 110 euro, right? Because the exchange rate is 1, ceteris paribus, we keep everything constant other than interest rates, right? So the exchange rate is 1, but the next year, the value of your investments became 5% more, right? What happened in this case? In this case, of course, everyone tried to convert their money to the US dollar, isn't it? Demand for dollar will rise. Exactly. Then the value of dollar in terms of euro, of course. I mean, we have two currency, euro and dollar. So the value of dollar increased. I mean, dollar appreciates, right? Everyone tried to convert their euro to dollar to enjoy the high interest rates, right? So the currency in the short run increased to, I mean, 5% goes up. I mean, 105, right? So it is shift to it's shift from D1 to D2, right? So we came from here to here. From 1 to 2 comes to 0.2 because of the height of that currency. We cannot change the quantity of dollar assets in one day, in short run, right? So that's why we have a vertical line here. So if it is the case, because of the excess demand, the currency, the US dollar, appreciates. So you see the effects of interest rates on the currency, the exchange rates. Is it clear, guys? Question? Right, Alish, the return for US dollar is higher than euro, right? But the exchange, because of changing the exchange rates from the euro investors' perspective, there will not be any right. There will not be any additional return. Think about it, right? Let me write here. So we are starting with $100 and €100, right? So 1 year later, it's became $110 and €105, right? Let me calculate. Give me a few seconds. Okay, let me show you. Right. Assume that we are starting with the $1 is equal to €1, and we are starting with the $100 and €100, right? So 1 year later, it's became $110, right? Because of the 10% interest rates, and €105, right? If you invest in euro, I mean, from the euros investors' perspective, €105, right? So because of these differences, everyone tried to invest in US dollar. All the European investors tried to invest in US dollar. The demand for US assets has been increased, right? Then the currency increased to $1 is equal to €105, right? So yes, but the 5% is already gone here, right? Approximately, I mean, of course, when you divide the numbers, it's not exactly the 5%, it's 4 point something else, but it's very close to 5%. But approximately the 5% of this return is gone by this the exchange rates movement, right, Alish? Yes, it still pays more, but the exchange rate has been changed. The 5% is here. Good. Right. Of course, if the the vice versa is true as well. If the euro interest rate increased, it's shown as IF, interest rate in foreign, right here, IF. If the euro interest rates has been changed, increased, then this curve, demand for US dollar curve, shift to the left, right? So the vice versa of the last slide. Clear question? Clear. Good. Same thing. Okay. So, to summarize, an increase in the foreign interest rate shift the demand curve to the left and cause the domestic currency to depreciate, right? And the vice versa is true as well. Okay, let's move on to the next slides. Well, expectation. The expectation is one of the important factors in exchange rates. It has a very important role. Assume that you are expecting, well, this is not by expectation. This is just an example, right? Assume that you are expecting a devaluation in Azerbaijan, right? It's not the case. It's just an example once again. What happens? Are you wants to buy US dollar right now or wait until the devaluation? Right now, you are buying right now. Why? Because of the expectation, right? Even there isn't any devaluation, nothing happened right now, but because of the expectation, you are buying it, right? So you see the how your expectation or the you see the role of expectation in the exchange rate markets, right? If you expect to change in the future, you buy it right now or you sell it right now. You are not waiting for it, right? You see, that's why the expectation of anything, not only the devaluation, but the expectation of the other things as well, has an important role in determining exchange rates. Clear, guys? Is it clear? Right, right. So the rise in the expected future exchange rate shifts the demand curve to the right, okay, which is immediately the exchange rates appreciate. Okay. Uh, the earlier, I mean, last lecture, we talk about the long run dynamics, right? We talk about the yes, Ramis. Yes, no, yes, you're right. Uh, if I mean nobody is expecting a devaluation, so for I mean I'm not for the Azerbaijan, but but the Azerbaijani manat is managed by the central bank, so it's not the our cases, but it's just for an example. Uh, if if it is freely determined by the markets because of this expectation, right? The currencies appreciate right now or depreciate based on the expectation, of course. In our case, it was the depreciation, not the appreciation, but the depreciation. But right now, I mean, nothing happened. It's not, it's our case, right? Ramis, we are talking about the and freely determined free markets. Okay. Last time we talked about the long run dynamics. You remember that the relative price level, which is the inflation, or the tariffs, or the trade, the export and imports, or the productivity, these are the main factors affecting the exchange rates in the long run, right? So any expectation on these long run dynamics affects the exchange rates in the short run immediately. If you know that the US dollar inflation rate, the relative price, the inflation rate is higher than euro area, right? It's an expectation. It's not the reality right now. I'm talking about the first one, right? This one. So it's an expectation. It's not the reality. But everyone expects to high price level, high inflation level in US compared to eurozone, right? The currency lose its value. Okay. So because of this expectation, it has an immediate effect in the short run. Same for the trade barriers. A few years back, few years ago, Mr. Trump announced the trade barriers for China, right, for the Chinese goods. So what happened to the US dollar? Immediately appreciate. The trade barriers, of course, these takes time. It's not we'll see the effects in the long run because of the trade barriers. But short-run effects is the appreciation of US dollar immediately because of the expectations. And you know that the Trump didn't announce the trade barriers, right? Same for the trade, export and import, the expectation based on export and import. Same for the expectation for the productivity, right? Because of the trade barriers, let's talk about the American Chinese cases. We assume that the US is the home country, right? And Mr. Trump uh, put a increase the trade barriers, right? So if it is the case, the Chinese goods became more expensive for the US consumer, right? Then the demand for US dollar has been increased, then the US currencies appreciate. If US put a additional tax on Chinese goods, okay? So as a summary, if domestic interest rates increased, right, the currency appreciate. If foreign interest rate increased, currency, home currency depreciates, right? Uh, expected inflation, if expected inflation, of course, the domestic prices has been increased, currency depreciate, right, and shift to the left, of course, right? Uh, trade barriers, if you put a trade barriers in a home country, currency appreciate. I'm sorry. If the demand for imported goods increased, currency depreciate, if the export increased, of course, we are all talking about the expected. I mean, not reality, not real, but the expected. Currency appreciates, productivity increase, currency appreciates, right? So it has the same effects like long run, but it has an immediate, because of the expectation, it has an immediate effects in the short run. Right. Any questions up to now? Good. Okay. Good. uh, so we have to be careful about the. I mean, the exchange rates. Many factors affects the exchange rates, right? So we have to be careful about the reason of uh, exchange rate change. The reason might be any macroeconomic factors. For example, uh, this change might be the change in the interest rates or the change in the money growth, right? Right. You know that, you remember that the Fisher equation, if I'm not mistaken, we talk about it. Basically, the Fisher says that the nominal interest rate is equal to real interest rate plus inflation expectation, right? You remember? So, we have seen that if in this slides, right, if your interest rate increased, right, the domestic interest rate increased, your currencies appreciate. We know it, we have seen this. But the nominal interest rate has two components. One is the real interest rate, the other one, the other part is the inflation expectation, right? So we have to examine the source. If it is real rate part, the currencies appreciate. If it is inflation expectation part, then the currencies depreciate. So each has a different effects, right? Once again, we remember that. Let me write here. The nominal interest rate has two components, right? Right. One is the real interest rate. The other one is the inflation expectation, right? So this is the Fisher equation. So we know that if the interest rate, if the nominal interest rate is increased, we know that the currencies appreciate. But it has a two components, inflation expectation and real interest rate. If this nominal interest rate increase comes from the real interest rate increase, right, then the currencies appreciate. If it comes from the inflation expectation part, right, then the currencies depreciate. So you have to be careful. You have to analyze carefully which part this nominal interest rate, increase in nominal interest rates comes from in which part, right? The source. Okay, guys, question? Good. Once again, if the real interest rate increase, the currency appreciates, right? If the inflation expectation increase, currency depreciates. Oops, sorry. So this graph shows the increase in the expected inflation. In this case, the demand curve shifts to the left and the currency depreciates accordingly. Okay. Okay, any questions up to now? Clear. Good. Thank you very much. Right. Of course, in real life, forecasting the exchange rate is one of the important things for the financial institutions or any institutions, right? Assume that if you forecast is euro appreciate and yen depreciate, right? If you think that in near future euro will appreciate, of course, in this case, you try to increase the euro assets and decrease the yen assets, right? So basically, FX trader sell yen and buy euro, right? Because of this expectation. So this expectation plays an very important role, and in real life, FX traders try to analyze, try to understand the, the exchange rates direction, the movements. Right. Okay. I have a easy questions for you. Please read the first one, first question, and choose A, B, or C. One of those alternatives, right? A dealer based in New York City provides a spot exchange rate quotation for 12.4035 for Mexican peso to US dollar, right? Means that $1 is equal to 12.4035 Mexican peso. A client in Mexico, for the client in Mexico City, right? The inverse is 12.4012 is 0.0806, right? Means that one Mexican peso is equal to how much US dollar? From the perspective of Mexican client, which one is the correct one? A, B, or C? Rami says C, the others say B. So you remember the B is the mostly B, right? Ramis, it's B, I'm sorry. You remember that the direct quotation is from the location, related with the location. So we are looking from the Mexican client's perspective, right? So the direct quotation is the one price of 1 unit of foreign currency from the Mexican clients, right? Foreign currency is the US dollar. So 1 US dollar is equal to 12.4035 Mexican peso. So B is the correct one. Yes, Dilara, right. Okay, the second one, uh, you know that like Azerbaijan, if you want to buy if you want a quotation for manat US dollar, you'll see 0.6970 is the bid. I'm sorry, 1.6970 and 1.7030 is the offer, right? For the Azerbaijani manat. Let me write here. So 1.6970 is the bid rate, 1.7030 is the offer rate for the manat, right? Same for the Mexican peso and US dollar quotation, right? So, what is the US dollar Mexican bid offer quotation in this case? So, which one? A, B, C? The first one, A. Right, right. You are all right. Because the bid should be always less than offer. Right, right. I mean, you have to buy cheap and sell expensive. B cannot be. If it is the case, I mean, you have an arbitrage opportunity. I mean, buy cheap, sell expensive, which is meaningless. And the C is the both quotations are the same, cannot be. Right. A is the correct one. Good. Yes, Ulvi. Uh, Sabina, for the B one, this one, buy expensive and sell cheap is meaningless, right? So that's why it's A. That's why, yes, I said, but to explain the B variant. So A is the correct one, B cannot be because of what you said, and C is out of question. Ulvi, if I'm not mistaken, you have a question. Yes. Okay, what if the question says from the perspective of dealer in the New York City? So the direct quotation, if it is the case, direct quotation should be one foreign currency, which is Mexican peso, is equal to how much US dollar, right? So the first one, the one Mexican peso is equal to 0.0806 American dollar, US dollar, right? The direct quotation is based on the location of the speaker. Clear question? Right. Uh, Guys, we have 10, 5 to 10 more minutes. Um, well, I have this. Here is the solution one and solution two and explanation. You can check it by yourself. Interest rate parity condition, but I don't want to start the interest rate parity condition now. I have a question here. Right. Right. Let's solve these questions and we'll cover the other parts later. Right. On February 1st, the euro worth 89.84. By May 1st, it has moved to 0.94. I mean, 1 euro is equal to, of course, 0.945857 dollars. So in this case, euro appreciate or depreciate, and how much? Ramiz depreciate, Elshad appreciate. Appreciate, 5.2, appreciate. Cengiz depreciate. Fidan depreciate. So we are talking about, right, 1 euro. Okay, the euro worth. So 1 euro is equal to 0.8984. Then it's moved to 0.9457, right? So €1 is worth more dollar, isn't it, guys? Those who says depreciate, right? So €1 worth more dollar. Then it has appreciated, right? By what percentage? As you calculated, 5.20, 5.26, 5.27. Right. The other side of the coin is depreciation of the dollar. If euro is appreciate, then the dollar should depreciate. Right? How much? Please calculate the depreciation of the dollar. Is it the same? 5.27? It's not 4.73. Check it once again. Yes, Cengiz, 5%. Yes, 5. Right. So if one currency is appreciate, the other one is depreciate, but the appreciation and depreciation rates is not the same, right? Because of the math. I mean, how did you get 5 point? Yes, guys, how did you get 5.27? Let me write here. So 0.9457 new minus old 0.8984 divided by old 0.8984, right? So this gives you 5.27%, if I'm not mistaken. Ulvi? What about the 5%? Right. So we need to calculate the $1 is how much euro, right? How can you find it? By 1 divided by 90, sorry, 0.94, what's it? 57, right? So this is equal to 1 divided by 0.9457 is, you convert $1 is how much euro, right? Then, right, this one, right, exactly, Fera. So convert everything to the dollar, Ulvi, right? Calculate 1 over 0.9458 and 1 over 1 divided by 0.8954, then calculate it based on this new, from the dollars perspective. You will end up with the 5%. Okay. Okay, guys, we have few minutes, few more questions, but we'll cover later on. I'm stop recording.